Welcome to the Global Chief Investment Officer Symposium. This session is entitled Paradigm Shift, Global Investment in a Restructuring World, co-hosted by Financial Times and VS Partners, a boutique asset management firm that invests globally and pioneers an outsourced chief investment officer model in China. My name is Neil Beveridge, and I'm senior analyst with Sanford C. Bernstein in Hong Kong, and I'm moderator of today's panel, Global Energy Transformation, a Carbon Neutral World with Fossil Fuels in it. As we speak, the UN Climate Change Conference is underway in Glasgow. World leaders are gathering to discuss what needs to be done in the face of climate change. Transitioning to a carbon neutral world is a commitment that an increasing number of countries and corporates have pledged to. Are we going to enter a 100% renewable world? Where does that leave fossil fuel energy? And where does this mean for investors? I'm delighted to be joined by two very experienced investors today, Rod Sadlington and Christian Zan. Rod is the founder and CIO of Merryweather, a specialized energy long-short fund backed by significant energy companies. Previously, it was at Carlson Capital and Oxif Capital, managing energy specialized funds for over 15 years. So good morning to you, Rod. Christian is the founder and CIO of SourceRock, a specialized energy long-short fund. Christian spent over 15 years at Balyasny, one of the largest hedge funds globally, as a partner and portfolio manager dedicated to energy investment, and managed one of the largest energy trading books on Wall Street. So good morning to you, Christian. Good evening to you. It's morning in Hong Kong. Let's just start off with oil markets. So over the past 18 months, we've seen a pretty dramatic turnaround in the fortunes for oil. Moving from negative prices, super contango into $100, close to $100 a barrel prices in a far more backwardated structure. How do you see the current oil cycle relative to the last super cycle that we saw in the 2000s? Where do you think we are in the cycle, and how are capital markets responding to this regime shift that we're seeing?
Christian, you want to kick it off, bud?
Sure. Yeah, I'll kick it off. Thanks, Neil, for the question. I'll start by saying that this cycle could not be any different than the previous 5 to 8 years, and really any cycle I've seen energy. I started covering energy in 1997 when I was working at Fidelity. And what's so unique about this cycle are a couple of aspects. One, the ESG angle and the pressure for companies to not spend money in fossil fuels was not prevalent before, and because of that, companies are not responding to the price signal that they typically would respond to. In fact, energy used to be quite the opposite, where even the hint of oil prices going higher would quickly lead people to increase in their capital expenditure budgets and standing up drilling rigs and looking to produce more oil. And what's interesting about this cycle is we were already starting to see capital discipline before COVID. We had kind of the binge of shale from the 2010 to 15 period. In 17, 18, 19, people realized they weren't getting the return on their capital. So we were seeing money pull out of the space. And then COVID really accelerated that. And so that left us in a period where now we're recovering from COVID. Demand is back to all-time high levels. And yet there's still this pressure to not spend money. And so we're seeing really strong capital discipline. And then to your point on the curve, and then I'll hand it to Rod, but on the curve, we have such backwardation where historically we see more contango, where the front of the curve is in the 80s as we speak, but the back of the curve is more in the 60s. And so we're also not getting that price signal from the back of the curve to really incentivize spending. So we have all of these reasons for companies to not spend money, which should prolong kind of higher than mid-cycle prices, in my opinion.
So Rod, on you go, Rod.
Yeah, I agree. I mean, look, this is unlike anything we've seen before. I think it's one of the greatest supply side rationalizations in terms of capital starvation out of any industry. I mean, we have stats where between 2010 and 2018, we'd raised about 31 billion in the US markets of equity and 44 billion of high yield per year, 75 billion a year. We're not even close to that these days. And I think the only analogy I would use would be the supply side rationalization of the US airline business, where you had a horrible business, right, way over capacity. Then what they did, they took capacity out. Then you had rationalization and mergers. Then Warren Buffett invested, because apparently airlines are uninvestable. And Christian knows this because he used to do industrials. And then for a period of 10 years, they printed more money than maybe any sector in the US economies pre-COVID. And I would suggest, along with Christian, that you have an enormous supply side rationalization going on, such as, for example, we used to spend $750 billion annually on global capex, so now I think we're at $350. Now, it had taken some time, right? We've got a depleting asset base as well. The widget factory falls over, unlike other businesses. So you build a factory, and in 3 or 4 years' time, it falls over. What had happened is we got very efficient. So not only do we have in that sort of 09 to 15 cycle and beyond, not only do we have excess capital, we got more efficient. Like BP went from 80% uptime to 95% uptime in the North Sea. But those efficiency gains are now over, such that it feels like the boy who cried wolf. Like, we've always heard of the decline curves. When are they kicking in? Well, guess what? When you look at Angola, when you look at Nigeria, it's right now. And so now you have what Christian's talking about. You have a structural supply side whereby the mid-cycle price of oil has to rise. Price balances demand and supply, okay? So the price has to rise to either incent demand, kill demand or incent supply. And we think eventually, we model out all this work. And so we were using a 55 mid-cycle price. We're moving to a 70 mid-cycle price because at the end of the day, the US, once OPEC gets full, once OPEC reintroduces the barrels back online, knowing that some OPEC countries are impaired, the well quality in the marginal basins, being the United States, is actually deteriorating. And so the marginal price, therefore the mid-cycle price has to go up. And we think it goes from 55 to 70.
So Christian,
mid-cycle, it can go beyond there.
So Christian, just to follow up on that, I mean, we've obviously seen, a significant downturn in US capex spending, but of course, this is where a lot of the short cycle flexibility still exists. How do you see the US's ability to respond to these higher prices? Do you think that there's going to be a certain price where it really starts to kick in meaningfully, or do you think the resource base is fundamentally changed, consolidation has changed, capital markets have changed so that this doesn't happen?
Yeah, I think two things. Rod mentioned the resource base has definitely deteriorated, so you need that higher price incentive to spend. But I think more importantly, right now, there isn't the will or desire to spend. What these companies have realized is the more they spend, the more the treadmill accelerates, the higher the decline curve, the more capital then required. They've decided, okay, if you take Pioneer as an example, the basic model is grow somewhere between 0 and 5%, spend maintenance capital, take the excess free cash flow and distribute 80% of that to your shareholders. That's the new model. I mean, it's Shale 4.0. And never say never, but the resolve has been exceedingly strong. I mean, oil's gone from, as we know, negative prices in March of 20 to, like I said, in the 80s now. And we still have not seen the rig count really move from the public operators. We have seen the private rig count pick up a fair amount. But in general, this was a basin that was growing 1 million barrels a day on an annual basis consistently. We had stretched, I think, there's some numbers as high as 800,000 barrels a day. We don't think there's any chance you get there. And so we think it's probably at best kind of half of that former growth rate.
Right. In turning to you, Rod, on the other kind of area where we could see supply is OPEC. Obviously, there's 4 to 5 million barrels of spare capacity that will be coming back onto the market, according to OPEC plus policy. Also, Iran, Saudi, the UAE have also talked about raising, production capacity. Do you think this is enough to offset some of the declines that we're seeing in non-OPEC conventional supply?
Yeah, I mean, you're going to get to a point. I mean, right. So, I mean, we're still drawing throughout the first half of next year by our math because they've withheld barrels off the market. But given where demand is, we've now got a view into COVID-19, in a post-COVID-19 world. Now, we just had a 9.5 million barrel a day gasoline print here in the United States last couple of weeks, around 9.5, 9.6. Now, that's very high. So, look, those barrels will come back to market because, oil price will get away from you. But when they do, because demand now is back to around that zip code 100 million barrel a day mark. And so those barrels are actually needed. I mean, if you look at the inventory situation, whether it's product or whether it's crude, I mean, it tells a very telling picture. And so days of supply, I mean, is is challenged, and we need the barrels back. And then beyond that, right, and then that is the question, is beyond that, you must send a price signal, right, that will encourage, you know, the marginal basin to produce, which I believe with then a short cycle basis, which is the United States. So the barrels are going to come back online. The OPEC barrels will come back online, but they are absolutely and utterly needed.
Right. And you talked about, you know, that need for additional barrels. And this brings us on to demand. Now, we've seen, you know, a strong recovery from record demand destruction in 2020. But there's a lot of uncertainty as to when we're going to hit peak oil demand and what sort of level that's going to be. So where do you see, you know, where do you see peak demand and at what sort of level?
We've modeled it out about 107, because you've got to understand that the demand function shifts more towards chemicals and away from transportation fuel as the incremental barrel of demand, okay? Only 30 million barrels of the 100 is gasoline. 30 million barrels a day of the 100 million barrel a day market is gasoline. And so in time, we see, obviously, the chemical complex actually being a greater proportion of demand. I will say that when we look at it, China is an unknown at the moment. Obviously, it's hard to understand the inventory situation there. Obviously, the teapot refineries have wound back. Obviously, the SOEs are producing more, the Sinopex, but you know, that could also be a bullish sign that eventually they do have to come back in the market. And demand, you know, although we would not expect Chinese demand to grow at the same rate as it has in the last couple of years, we still expect that to be positive, because when we run it out, you have you have a large install base of $1.2 billion install base of motor vehicles, 90 million sales a year. That's a lot, and it takes a lot to move that base. And so we still see demand moving up more gradually. But I would once again go back. I mean, you have areas of OPEC, Angola, Nigeria, you know, so on. So Venezuela's already gone, that are incredibly challenged, and you're going to need the Gulf 5 to produce.
Yeah. And so, Christian, would you agree with that? Do you still see demand as, you know, continuing to rise steadily, you know, over the 2020s and peak demand still being some ways off?
Yeah, I'll give you a quick anecdote. It's, you know, it's a relatively small country, 4.5 million people, but electric vehicle sales in Norway are now 75% of new vehicle sales, up from zero basically 10 years ago. And oil demand in that country over that period of time is dead flat. So to Rod's point, a lot of that is going to chemical demand. And so people think about transport demand going away, and we can talk about pace of EV adoption. But you have such an installed base that the new vehicle sales, it takes a long time to actually move that needle, even within the transport sector. The way I think about it is this: if I look out to 2030, I think you're probably in you know, you can make your assumption about 100 base today. I think you're probably somewhere between 108 and 112 by 2030. So let's call it 110. We're spending at a level to where our peak supply is around 102, 103. So there's this really large wedge. And the way I describe that is we've got a net zero world of, we're spending as if we're going to a net zero world, but the demand hasn't changed at all. And so that creates this wedge. And that wedge, whether it be, you know, in my math, that's kind of 7 or 8 million barrels, but even if it's only 2 million barrels, it's that marginal barrel that drives the price. And so you just have this wedge, I think, lasts for, you know, by my numbers, you're at least 5 years, maybe 10. And with the companies generating free cash flows in the 20, 30%, I don't need it forever for the companies to accrete cash flow positive. So we can talk about that. But the point is that we have a really messed up energy transition because the demand side and the supply side are behaving very differently. And that's creating this very, very different cycle we've seen historically.
If you listen to the media, it's as though we've produced our last barrel of oil and our last, you know, molecule of natural gas. And that when you look at the numbers and you do the analysis, nothing could be further from the truth.
Yeah. Yeah. So, you know, picking up on that point, and the Norwegian statistics, a fascinating one. But just if you look at that deficit that you're projecting, Christian, in the market, 7 million barrels, 8 million barrels a day. I mean, clearly at the moment we've got, you know, OPEC spare capacity, which is somewhat a buffer between oil prices doing what we're seeing in coal and gas. But once we exhaust that spare capacity, what sort of numbers could we see oil going to? Because obviously, if there's just simply insufficient supply to meet demand, I mean, that's a sort of unprecedented situation. So where could oil get to?
Well, I think because of the backwardation of the curve and because of the ESG mandates to not spend, to Rod's point, commodity either goes to a place to incentivize supply or kill demand. I really don't think you're going to incentivize significant supply. So I think you have to kill demand.
Yeah.
And so the way I look at that is you can look at a couple different ways, but in kind of the $110, $120 range, you start to see some pressure on demand to the downside. I don't think we'll see crazy kind of $200, $300 prices because of that demand response. Right. But I do think there's a fair amount of kind of blue sky between where we are today and where that price could ultimately go to kill demand.
Right. So ultimately, we could see a scenario like we saw, let's say, in the early 70s or late 1980s. We actually saw high commodity prices really being the trigger for a recession in developed economies.
Correct.
Yeah. I have a slightly different. I mean, I'm a little bit lower than Christian on the numbers, but the same. But I think that I reckon you get demand destruction around about 100 in terms of at the tank, so it's a little bit earlier, and then it's going to be very interesting. And the equities price mid-cycle. So when crude's at 100, you don't price 100 in perpetuity. You price your perception of mid-cycle. That's point one. So the stocks are going to act differently. Now, where crude gets to, I think that Christian, and this is the look. I mean, the stocks aren't pricing anywhere near it. To Christian's point, you can get your entire enterprise value back in 7 to 8 years. That's equity plus debt, right? Where the securities are priced right now through free cash flow, US E&Ps can get their entire enterprise value back. And so where does the commodity go to? I think that's going to be a question for the Gulf Five. And do they want to see another round of undisciplined shale spending, given the higher prices? And look, that's an unknowable question. But I'll tell you what, the mid-cycle price is going up. I think myself and Christian will definitely agree about that. Everything else is semantics.
Yeah. So when you look at the sector overall, I mean, you've alluded to the kind of free cash flow generation from E&Ps. They've obviously got very high, leverage to that, to those higher prices. But at the same time, what we're starting to see is all majors around the world, reallocate capital towards, clean energy. But, this has not really triggered, certainly a reevaluation, of these companies. So how do you see the opportunity in the oil majors, which have kind of got a foot in both camps, both in the clean energy world, but also exposure, to these higher commodity prices?
Let me have a go at this one, Christian. The oil majors, you have a fully depreciated asset base, okay? And so, for example, in mobility and charging, I really don't understand why we're allocating capital to mobility or charging station companies when the oil majors have a fully depreciated asset base. And I think Shell's going to put in 25,000 locations, BP the same, Royal Total the same. So that to me seems like a winning strategy from, in terms of promote flow from the majors versus these independent charging. As well, we're also seen companies on the carbon capture side. If you can convert your fully depreciated assets, say some pipelines, and convert that over into a carbon capture strategy, and where you own the leasehold and you understand the geology subsurface, because the trick to carbon capture is not the capture of the carbon, it's the transportation and the storage. And if you have a fully depreciated asset base, then that's all margin. And that is what we would like to see the majors focus on. Where can I use my fully depreciated asset base to create the greatest economics to obviously tackle the environmental issues? That's what we would like to see. Some are doing that, but not in the scale that we would like.
Christian, how do you see it? Do you think the integrators are doomed, or do you think there's an ability to reinvent themselves?
Yeah, I mean, I agree with Rod there. What is the point of BP buying somebody else's wind or solar farm? Like, what does that do for the planet, for their returns? It's really hard to see it. So the way I look at it is the global majors are basically being forced to kind of shoulder the carbon burden of the rest of the industry. And so unfortunately for them, that is definitely a negative drag on their future returns. Flip it the other way, and look at the companies that, if you take North American shale producers as an example, that's a little bit less in that spotlight, not needing to shoulder that carbon burden. They are the beneficiary, because if you're forced to spend a certain amount of your capital on non-oil and gas investments that don't have quality returns, then your effective cost of oil supply has gone up in those companies that need to shoulder that burden. And so to me, it's a little bit of they kind of have to do it for public perception, but it's really not in my opinion kind of the right thing for the shareholder in most cases.
Right. So to paraphrase it, Christian, would you say that, in terms of investing within the sector, you would be a firm believer in the value opportunity in E&Ps rather than the integrateds at this point in the cycle?
Yeah, I mean, I think they'll all work, and the integrateds, have that nice legacy asset base, and they'll be able to generate, a lot of cash flow off of that base. But the returns in incremental capital, I think will be lower than you would see in kind of the pure play smaller independents.
And Rob, would you be on the same page on that one?
Yeah, I think select one integrated in particular, going out and thinking you can go and buy offshore wind farms at a 5% rate of return versus swapping out assets that you utilized obviously a lot higher. That is a strategy that's suboptimal. The strategy that works is, let's look at our depreciated asset base and figure out how to optimize that for the new energy world, which is, I suggest, carbon capture and obviously mobility. And so it really depends. It's a case-by-case basis, but it creates it creates a world of where there's winners and losers. I will say this, that energy, we look at this, energy generally and most people's weightings is around about 2% weight. That might be the weighting in the S&P. Do you know, on our math, it's going to be 6 to 8% of S&P earnings next year. Right. So I would suggest, look, they're all going to do well, and some are going to do better than others based on their strategy.
And Rod, that brings up an excellent point here of the valuation differential between the earnings and the free cash flow generation of these firms and where they're valued at. And part of this, presumably relates to ESG, which has become very much mainstream, in the investment decision-making process of many, buy-side firms. Leading to anomalies, I think, in valuation relative to intrinsic value. So, do you think ESG is kind of creating these disconnects that we're seeing, with firms just unable to invest in the sector? And how do you kind of take advantage of this this trend?
So, firstly, ESG, you're right. It does take capital away, and it's created that vacuum that Christian and I talked about. The $750 million we used to spend versus the 350 now. So ESG, and that it creates that vacuum. I will have, on a side note, I think that ESG, when you actually look at the holdings, it creates opportunity because ESG funds don't invest in energy or new energy holdings. If you look at the top 100 holdings of now this is unbelievable. If you look at the top 100 holdings out of all the large US ESG funds, the top 100 holdings, I've got it right here. This is them. NextEra at number 24, ExxonMobil at 28, Chevron 35, Linde 46, ConocoPhillips 79, Eversource 86, Exxon 97. That is not called investing in energy or new energy. So an ESG fund is investing in the S and the G, and not investing in the E. And what they're doing is they're trying to charge active management fees, and they're replicating the S&P. So what that's doing for us is, because they don't understand the E in ESG, that creates a void of mispricing. And that is, I think Christian agree with me. So not only we've got capital evacuation out, the ESG funds aren't filling the void here in new energy. They're just not investing in it. And on top of that, Neil, we calculated that we lost in the last cycle around $3 trillion. And there's a great saying, money follows returns. And so that's why we find right now, I find the situation right now the most attractive investing opportunity of my entire career. And I don't say that lightly. I absolutely believe that because of the evacuation of capital. Christian?
Yeah, Christian, let me kind of put this onto you. I guess Rod's brought up the point that he sees one of the best investment opportunities in his lifetime. I guess when you look at the opportunities in traditional energy versus clean energy, Some would argue either way, that both present pretty unique investment opportunities of a lifetime. So how do you see it? Where is the investment opportunity of a lifetime?
Yeah, we've really been focused on, I think about energy transition as kind of going A to B. And before we started, Rod and I were chatting about this. A lot of people are just trying to do B without understanding A. And what I find interesting about that is in A, what we have is an evacuation of capital with all-time highs of demand for that product and a real dearth of analysis being applied to that group of stocks. Right. So to me, that is, as Rod said, one of the better investing opportunities. And I'll speak for him as well. I don't think he's talking about it as from an aspect of we think oil is going from 80 to 200. It's that alpha opportunity within that group of stocks because of the reasons I mentioned. If you look at point B, where we're going to in transition, we actually have the exact opposite scenario where it's still a relatively small market with way too much capital going into that market. With return, the BP example of 5% returns is a classic case of people just shoving money into the space because they feel like they need to. And so to me, point A is a lot more interesting. Now, you need to respect the fact that within point A, right, eventually there is some terminal value of oil question. We can all debate when that line is. But when you're investing in the earlier part of the transition cycle, we're really focused on one of two things. You either need companies that are paying out large amounts of cash to their shareholders. Therefore, we don't need to make an argument about the terminal multiple of that company because we're, like to Rod's point, if you can generate your entire enterprise value in, some of these companies are as low as 4 years, but let's call it 4 to 8 years, then we can take off the table the question around what is the terminal multiple we should put in that company. But then the other bucket that's super interesting to us is there are a number of traditional energy companies that are in the GICS code of a traditional oil company. So they don't seem to be investable by some group of ESG investors, but they have really interesting kind of energy transition options. Rod mentioned one, carbon capture is a perfect example, where if you have some type of lower carbon oil solution, that's a super interesting angle, because I think what we're learning during this transition is we kind of got to live to deal with oil, right? So it's okay, how can we decarbonize what we're all addicted to? And so there are a number of companies that have really nice optionality embedded that the market is not seeing. And so those are the two kind of areas we're looking at. And again, we're more kind of focused on the A part of transition than we are in B. And I think there's plenty to do there for a number of years. And so that's what's exciting about what we're doing here at Source Rock.
Okay, so very, very clear where the opportunities that you see in the market are. But I put it to you that $100 trillion is going to be spent over the next 30 years on the energy transition. I think the IA we're talking about $4 trillion a year, from 2030 onwards. I mean, that's an enormous amount of capital. Now, while I think some of the clean energy stocks have certainly, outperformed, over the last couple of years, there's still a long way to go, in this, and there'll be a lot of money to be made here. So, within the clean energy space, where do you see, the kind of the most interesting opportunities along the value chain?
Yeah,
and within the different.
One thing I want to mention there, like to the investors out there, you go, in order to understand, doesn't matter, we're in the widget sector. We've got the incumbent and the disruptor. It wouldn't matter what sector you're in, you must understand both. The disruptor affects the terminal value of the incumbent at different parts of the value chain, and vice versa. Once you have the disruptor has two revenue streams, a free market revenue stream and a regulatory revenue stream created by the government to incent. Once that regulatory revenue stream rolls off, you got to know what you own and where you are on the cost curve. And this is the point. So one affects the other. When that does, the equity values are based on rate of adoption, rate of penetration, path dependency, which will be eventually determined by free market economics as the regulatory revenues roll off. So even though, but here's the point, Neil, like we may be throwing all this money at the problem. Is the money being thrown at the right companies to solve? Yeah. Just because we throw money at it, it doesn't mean we're going to solve it. It's point number one. I think the governments need to understand. So, and then two is the ESG funds, they're certainly not going to get involved because they don't hold any of the stocks. So they're not the answer. So we've got to direct capital the right way. And then where we think in the value chain, I mean, realistically, look, there's one Google, there's one Amazon, there's one Netflix. We have deconstructed the new energy value chain. We think currently it's about 3 trillion, a market cap. 1.5 trillion is on your traditional utility project developer side. But we really think it's really in some of, you've got to understand the value chain. And this is how we do it. Just in energy, we are oil, we're fuel source value chain. Oil, the oil value chain, LNG value chain, natural gas value chain. Solar, the solar value chain. Wind, the wind value chain. Renewable diesel, the renewable diesel value chain. If you can understand the value chains, the margin accrues to different companies at different points of the economic cycle in each value chain. And there will be winners and there will be more losers than winners. I mean, let's go Resi Solar. We do believe there's a couple of companies there. We can't mention names of winners. Renewable diesel for one, right? Obviously, that's a great example of understanding the incumbent and understanding the disruptor. And then understanding in renewable diesel, it matters where you are in the cost curve. Are you sourcing your renewable diesel from tallow or used cooking oil, or are you doing it from soybean oil? We think in other distributed generation, we think renewable natural gas. We don't think it's in the project developers, I'll tell you that much. As Christian pointed out, 5%, that 5% unlevered doesn't cut it. We think it's in the ancillary services, like battery packs to when you put a 100 megawatt battery pack and you integrate that project, then you get a 20-year O&M contract, and then you have software sitting on top of that to increase the dispatch and manage the actual emissions. That is a business model that works. Just putting a wind farm in and hoping you get 5%, even when your supply chain costs are going straight up, that doesn't work. And then we think lithium, we think raw materials, carbon capture, and EV value chain. Christian, you want to add anything to that? I mean, there's opportunities everywhere, but guess what? There are going to be more losers than winners. There are 45 SPACs out there.
Yeah.
Do you think there's 45 great ideas? No.
Yeah. Before going to Christian, just to follow up on one more point, Rod. Anywhere you'd see a kind of where you think it's overhyped, and where you think there is within the value chain or within any of the verticals where you think really expectations are too much capital taking to kind of
mobility is laughable. Right. I think that just think about it. You're competing against the majors who have a fully depreciated asset base. There's EV fast charge. I mean, in order for EV, you got to have EV fast charge. Some of these companies have slow charge. I am not sitting on the side of a road for 12 hours to charge up my EV, right? And so the rollout of that infrastructure and the expectations around that are borderline delusional. And we could go into some other stuff. And then there's,
Well, let me pass it over to Christian. I mean, so Christian, would you agree with Rod's kind of take on this, that there is a kind of winner take all dynamic here, which isn't really the same as traditional energy markets that applies to new energy. And similarly, where do you see the best opportunities amongst the verticals?
Yeah, he kind of took the words from my mouth. I was going to say, if you go back to the .com era, right, you had a couple enormous winners come from that, kind of late 90s. The reality is 95% of the companies are zeros, right? And a few guys took it all, right? And I think it would be a similar type scenario. We still don't really have any breakthrough battery technology, right? Tesla is not a breakthrough technology. And so I think we're still yet to see who those winners will be. Rod mentioned NextEra. NextEra did a really good job of being out in front of others in terms of taking advantage of the regulatory situation in a positive way, but being early in terms of renewable power sources. And so some companies have been early movers, which has helped. But I still wouldn't argue NextEra really has a technological advantage versus its competition, right? The space is getting more competitive in terms of developing. So I do think you'll have a few winners. I think it's way too early to say who those winners will be. I mentioned Tesla as an example. That's winning the market cap battle today, but it's really just due to a lack of alternatives, right? It's not based on, in my opinion, the technology being any better or anything like that. It's just purely based on what is available to the investors. So far, it's kind of more just a battle of market caps versus a battle of, hey, this company has a better mousetrap. That over history has been a really dangerous area to invest when you're just chasing market cap without actually having a business model that makes a lot of sense. And so, you use the Amazon example. It took 4 or 5 years before people realized that, wow, Amazon sells more than books, right? I mean, these things take a long period of time, but then once you start to see it come together, wow, okay, this guy's going to take it all, right? And we're still really early in that phase. And I wouldn't volunteer actually a single company in kind of new energy that fits that bill at this point.
Okay, that's fascinating. But it does make a great environment for stock picker, let's say, for the buy side, for truly understanding these companies. But as you said, more losers than winners, and understanding who has the sustainable technology lead, absolutely critical. On policy, Christian, if I can just push a bit further on that, because clearly within the clean energy space, policy is just so fundamental to a lot of this. I mean, how do you take into account changes in policy in the investment decision making process when you're investing?
It's a great question. And I would argue that in new energy, actually understanding policy is equally or more important than the actual company models themselves at the current time. If you look at wind and solar 15, 20 years ago, the credits just weren't high enough to really establish a business. And so we kept cranking the credits higher to get to a point to where we could drive the business. We're seeing the same thing in carbon, where you get a carbon storage credit called 45Q. That credit's currently $50 a ton. We're already seeing talk of that going to 85 because we're realizing at 50, nobody's actually behaving any differently. So we need to jam that number higher to make the economics of actually storing carbon more attractive. Rod mentioned renewable diesel is a good example. We have the low carbon fuel standard in California. You get a credit based on the carbon intensity of your gallon being sold. So you get no credit for fossil fuel, but you would get credit for soy or tallow as your input in that renewable diesel. So understanding, we don't just have to understand the supply demand of oil and natural gas. We actually need to understand the supply demand of LCFS credits, and then what the state of California is going to do with those credits. Will they tighten up the market to therefore further incentivize additional renewable diesel? Will that program shift to other states, Washington, Oregon, Canada, areas where they're talking about having LCFS programs? So that is a huge part of what we do, because understanding that renewable diesel, as an example, wouldn't exist without LCFS credits. The economics don't work, right? And so a lot of these businesses, I mentioned Tesla. Tesla started from the LCFS program of basically the incumbent OEM guys essentially paying in credits that were then distributed to Tesla for selling zero emission vehicles. It's just the way these things have worked over time. And part of the asset is pattern recognition of seeing these things historically. And then when these things take, they can provide a really nice umbrella of above kind of what would be normal cost of capital returns based on companies understanding how to utilize those credits.
Right.
Rod, anything you'd like to add there in terms of how you think about
this is the most important point for investors, and why you need guys who know what they're doing. Christian, there are 3 sources of regulatory revenue for renewable diesel: the LCFS, the RINs, right, and then the blender's tax credit. You have to separate the regulatory revenues from the free market revenues. Because in time, guess what? We think, and Christian will probably agree with, the LCFS is going to do that. It's going down, right? So if you're not where you are on the cost curve of renewable diesel, which is meaning, one company sources renewable diesel from animal fats and from used cooking oil, right? That's unrelated to the majority of them, which is soybean oil, which is clearly going to increase soybean oil demand by 40%. So this all breaks down to, once again, first principles of commodity investing. Lowest on the cost curve wins, right? Because in time, right, that regulatory revenue has to go down. And Neil, for example, in California, it's a $6 per gallon tax on the economy. That's what renewable diesel is. So it can't be, and only $2 of that is the free market. It's $4 is regulatory. But in time, that regulatory revenue is going to go down. So if you're highest on the cost curve of producing renewable diesel, you're going to have a challenge position going forward, right? You're only making money now because of the regulatory regime. And once that regulatory regime changes, you've got a problem. And you need to recognize that.
Yeah. Rod, I mean, just to kind of think about how things are likely to play out from the future. We've discussed a number of different areas, but in some ways, if you look at what's happening in energy markets today, we've seen LNG prices go to $35 and almost $200 a barrel equivalent. Coal at $200 a ton. Oil prices, maybe in the early innings of what could be another super cycle. I mean, isn't this kind of volatility that we're seeing in prices? Isn't this kind of here to stay with the energy transition in terms of what we're going through? Isn't this an inevitability just of having a transition?
When you have supply side rationalization caused by capital evacuation, yes. And so Christian said A to B. So we're trying to go from here. We have 100 years of energy infrastructure.
Yeah.
We're going from here to here, and the government, I call it the field of dreams, like the build and they will come. The problem with that is that causes the $30 per MMBtu in Europe. That causes then we have no gas supply. We've got to pull on coal. So realistically, by not investing in the transition, we're doing exactly the opposite of what we intend, which is using dirtier fuels to fill the void. Because we're trying to go from here to wind and solar. Well, guess what? In Texas, I'm in Texas right now. We have blackouts. The sun don't shine and the wind didn't blow, right? And then they didn't spend enough money on winterizing the stuff. And so people here were freezing over winter. And that's what I think the message to me, to government, we are absolutely 100%, we are creating this issue. We are doing it ourselves. We're doing it to ourselves. We're creating volatility by evacuating capital.
But at the same time, obviously, we've got to bring down emissions to hit global warming targets, and that's clearly something that's very, very. Christian, if I can just bring it on to you, I mean, do you think it's intellectually honest though to say you can make attractive returns in traditional energy and also be positive on clean energy at the same time?
Yeah, I think so. I think we are getting to B eventually, right? So I totally agree with Rod. You have to understand A, but you are working your way to B, right? The scope of that line will be different. Maybe we're all surprised by what that scope looks like. But the way I would think about it is, and I don't mean to be negative on ESG investing, but it really does blow my mind that the same investor that says they can't own Exxon will have Union Pacific in the top 10 of their portfolio. I just don't understand why we continue to attack the supply side of it without attacking the demand side. And that's why we have this disconnect. And so from the perspective of you can't have our president at COP26 asking OPEC for more barrels while he's there. I mean, it's complete lunacy. And so until you really attack the demand side, that is going to be what ultimately drives the transition. And so the supply side, to Rod's point, is it's kind of basic cost curve, but this time around it's cost curve plus, right? And that plus is how quickly do we actually attack and shrink the demand side. And to what I said earlier, the irony to me is what's going to hurt the demand side is that the price went too high, in my opinion.
Neil, we're long short investors. Energy, in my view, is long short because there's dispersion between winners and losers. And it's where you are in the cost curve on both new energy and old energy. And that's why myself and Christian are probably the two, almost too long. There's certainly two of the, I've got more gray hair than you, Christian, but two of the longest tenured PMs here. And when you do it for so long, you do realize it's a lot. If you've got 100 units of risk, 50 units of that risk energy is a long short game if done with the right risk metrics. And because you have that dispersion between winners and losers, and it's exceptional. So we can generate returns. But I see our job realistically. Look, the transition is going to occur, and we want it to occur fast. I'm agnostic, but we got to allocate capital to the guys who are actually going to make a difference, and not to the pretenders. And that is the problem. Just because we throw money at the issue, for example, ESG investors, they truly, I just don't see that they understand new energy or energy, and so we're throwing money at that, but we're not solving the problem.
Right. Rod, Christian, unfortunately, we've come to the end of our time slot today, but I'd like to thank you both very, very much for participating on today's panel. That brings us to the end of our session today. We look forward to further discussion on this in the near future. Thanks and goodbye.
Thanks, Neil.
See you, Christian.